Hi everyone, welcome to another episode of Capital and Context. We're going to try and keep today's episode a snappy 10 minutes, so I'll cut the small talk to start, but welcome as ever, Sam Hallett. We're going to jump straight to it. We were quite UK heavy last week, but as we know, the US dominates the world and, geopolitics, economics. So just want to go straight in with the Fed and what's been going on there this week. So
yeah, we're very much back into, I think, the bond market being in charge of what's going on in markets. Don't get me wrong, the start of this month was a little bit of an unwinding of things, let's be honest, got a bit frothy, didn't they, in June, in terms of equities, etc. I think we're looking at the bond market being back in charge. So last night we had a hold. 3 people voted, though, for a hike. But it wasn't the press conference wasn't as hawkish in tone as perhaps was expected. So it was seen as the short end basically came down a little bit, but the long end basically it was quite a steepener, which made me happy because on US Treasuries I've just sold some more of the long end and kept what was on short end. So thank you very much. But the real yields on sovereigns debt globally at the moment, well, we covered this last week. Yeah. They're really attractive. The only question is are they going to keep on going up? Yeah. But they are at this moment really attractive. I was looking yesterday, so on our portfolios, I put through our monthly rebalance earlier this week.
When you say on our portfolios, you mean on
our letter portfolios. I really think we need to rename these at some point.
Don't get into that.
The really kind of lent into duration and moved into sovereigns and towards the tail end, just because of I looked at the Bank of England. Not surprisingly, they published all kinds of graphs, etc. But if you look at the instantaneous real yields around about that kind of like 15-year mark, you're looking at a 1-year forwards real yield of over 3%. It's really attractive on a sovereign, on a developed market sovereign. So, so that's where we're looking at a bit there. And yeah, obviously we've had a bit of a Iran war. Sorry, I'm kind of jumping.
No, back to US. If I'm gonna pin you back down.
Well, no. So yeah, no, but it's kind of that's kind of where it's leading to. So we have had the May CPI print came in pretty high at 4.2. It's interesting. Go back.
4.2.
Yeah. So it's interesting. You go back 12 months, and it was very much the UK was the place struggling with inflation. US, everyone was there like it's kind of mission accomplished. That narrative's kind of reversed, actually. UK figures are. I hope I've got it written down, but when I last looked, it began with a 2. I think it was something like 2. I think it's expected to come in like 2.6. It's within the range, basically, where it needs to be. There's arguments the BOE can cut. BOEs today, by the way. I don't necessarily expect them to do today. But in terms of, there's a few things I've been looking at this week as well, which is on the FX front. Don't get me wrong, people are thinking that the dollar's still going to weaken off, so I'm not looking at bringing back in that cable hedge there. But one area that I am looking at, which actually we've never done, is hedging to a degree our European equities. Obviously, Euro and sterling tends to trade in a bit of a band, to a degree, but it's looking like it's at the far end of where that band kind of is on a fair pricing basis. So just thinking like, actually, might be an easy free
110 end or 120 end.
So annoyingly, I look at it the other way around because everyone does Euro stroke GBP. So kind of people saying it could be going back up to spot 8.8, which must be about 111, somewhere around about there, I imagine, if you flip that over. So, certainly an argument there for for a bit of hedging there. Could, pick up possibly an extra couple of % of alpha in that sector.
Okay.
So, yeah, it's interesting.
Topic number 2, margin debt. If you could expand on that, I think it's a similar topic to what you were talking about in the UK, or
kind of, yeah. Yeah, it's very similar. So last month we hit a record of basically the buy side of investment banks borrowing money to buy more stock, so leveraging that basically the stock market. We hit a new record last month of 1.53 trillion.
Buy their own stock or other stuff?
To go out, be market participants. Sure. Yeah. So borrowing 1.53 trillion. And the thing it's not necessarily that nominal number that's interesting. It's the year-on-year growth. So it's over 50% up year-on-year. And if you take it as things like as margin debt as a proportion of, say, GDP, the long run median is 2.4%, but it's now at a record 4.71%. So there's just a lot of arguments out there that there's a lot of risk on at the moment. Like, that's great when you're riding it, but these risk on rallies, of course, they never. All things wind down eventually, and it's that they can be a compounding factor. Interestingly, it's not in my notes, but I noticed this. I put it in our, obviously we have various team chats, one of our 20. I put on there yesterday. VFT was mentioning that this bit of unwinding we've seen within the tech sector over the last, best part of a month now, because of the leveraging going in, hedge funds have been hitting their margin calls. Okay. So that means that obviously you then enter forced selling. So it'd be interesting to see where they're going to liquidate to pay for that. One of the popular ones over the last year or so was gold. So could be another downward pressure on that front. But we are moving out from our standalone gold position.
What if it was treasuries? Would that?
So yeah, again, that's enough. That's certainly a place where it could end up being. Thing is, though, is I think people are looking to get into treasuries soon on a hedge fund kind of level, rather than in terms of like they've held it for a while and actually somewhere to liquidate. But it could be if they're rushing around for somewhere for liquid instruments, then I certainly could be a selling pressure there.
Yeah. Okay. So is that just a theme to keep an eye on for yourself?
It's definitely something to keep an eye on. There's quite a lot of things to keep an eye on at the moment. It's interesting, talking about forward PEs at the moment are very difficult to. Normally, you look at forward PE and you can make a pretty good 2-line commentary as to whether do you think it's decent value or not. It's really hard at the moment because forward PEs are looking pretty cheap compared to recent memory, but the earnings growth consensus forecasts are huge. So it's like, hang on, is this just looking cheap because you're expecting growth to be ridiculous? And have you got that wrong? At which point, but it could be a bit wrong and things still look pretty good. But it's just one of those things to be wary of at the moment, which kind of leads into Act 3. So I'm kind of doing through it, which is emerging markets, because this is where this is.
Still got time? I know you're a bit tight today.
Yeah, I've got time. Okay. The just because of, you look at it as an index, and at the moment it looks incredibly cheap because of Hynix, Samsung, all of those kind of things. Their earnings are looking fantastic, but that means that the whole index looks cheap.
Yep.
But the thing is, though, is I sat in a good call earlier this week, and it had a very valid point, which is within EM, you've got like the tech space, which has been doing amazing, but everything else is like, let's bear in mind, obviously, EM has been the manufacturing part of the world now for quite some time. All of that kind of bit is actually hasn't been doing great. Yeah. And so you ended up with a very bifurcated market. And it's, there's so much leverage in EM at the moment. We covered it last week with the Korean Stock Exchange hitting its limits all the time and hitting its circuit breakers. But it turns out there's a huge amount of leveraged ETFs going on in Korea. So there's huge amounts of leverage. And it's just one of those things that it could not go well. The long-term picture looks good. It's just a case of, and this is what's difficult for our perspective, is we have to bear in mind the volatility of our clients' portfolios, which means that sometimes you have to look a little bit more short-term volatility in managing that rather than the bigger picture is great. So it's managing that is an interesting one at the moment. I'm finding had some good calls yesterday actually with Artemis.
Okay. One thing I was just going to from the notes, you say EM's only. I presume you mean EM equity, but EM equity's only beaten US equity on a calendar year once in the last 10 years.
Yeah, so that's one thing. So
being last year,
it's one of those things that everyone talks about. You've sat more than enough fund manager meetings. You know, one of the things that you hear so often is, look, when the flows start coming back into this space, you know, you hear it all the time. But I think with EM, it's interesting. The flows have started to pick up, but it's almost like they need the US to boil over before EM really takes off hard. I think that's going to have to be the driver, because the thing is, everyone still wanted to buy US still.
Well, it's still the story, isn't it?
It's
we
still
learned 5-6 years ago, as much as we wanted to fight it at times, and we did. It's a underlying current that just keep.
I said in call yesterday, as I like, don't get me wrong, US isn't necessarily somewhere that I see as being particularly full of value over a 3-year basis, but you got to be ballsy to make a big decision about that. You know, our benchmark position on 5 is roughly about 45% US equity.
It's ballsy a technical term.
It's the more professional term that I use on the podcast. Other phrases are available outside of working hours. But it's it's a tricky one. The thing that also I've been turned back on just with this whole, I think we've now reached. Do you remember with first time round with Iran? You kind of got to this point where it was tit for tat for about a month. Oil moved within the range. It was talks were on again, off again, but you knew that they were kind of talking. We've entered into that again now on this. Let's call it Iran Mark II. Go into that. So actually, I've been moving back into like emerging market debt again, because you know that's going to be a place that will really benefit from the story and the sentiment when that clears up. But there's a lot of good things going on in that space. Latin America is, you know, kind of the real yields in Latin America are nuts. But they are, you know, probably about to start a rate cutting cycle again there soon. So it's, you know, that's looking like an interesting area. But the thing is that I think in some ways I'm preferring emerging market debt at the moment to EM equity. The concentration in emerging market equity now is, people say about the S&P being concentrated, it's nothing compared to emerging markets. It's so concentrated. And actually, this is the thing that's going a little bit more interesting for the nerds that listen in, is so passives obviously hold market weighting, but if you an active fund abides by its UKIT's regulations can only have maximum 10% holding in any one position. Okay. We're now in a situation when active cannot overweight a significant part of the market because So
they be underweight even if it doesn't want
to. So was looking at
that doesn't feel right.
It doesn't feel right. No. Because the thing is, I was talking to the managers yesterday. They're like, "Yeah, we get it. We know the story. We'd love to add more, but we've got to be overweight because of regulations." It's nuts. So for the way around that, which I've considered doing,
buy the most correlated.
Well, what I've considered doing instead is
them. I assume they just have to buy the most correlated.
Yeah, there's the way. So I think it's Hynex, where typical, you know, emerging markets where they're conglomerate and it, you know, the the corporate structure is a mess. But what that means is that you can buy, I think it's SK Hynix. Yeah, so you can buy SK Hynix, and then there's like a holding company which also holds it to a degree, but then there's also the parent company. All three are listed.
Right.
So you can, in essence, you can buy SK Hynix 3 times by buying that, and that. So that's what they have been doing. But yeah, it's one thing, as you know, that I have been considering doing is, say, like with US, buying the S&P equal weight and then buying a standalone tech fund and go about it that way. But it boils down to various things, but I think we're kind of running out of time.
Yeah.
Actually, I think we covered it all.
Those were the 3 bits I know we wanted to touch on, really. So yeah, we'll wrap it up there. Just wanted to say we've had a very consistent 2-3 weeks now on our daily posts on the CBAN website. So please check those out as well. Variety of sort of press-driven content, a bit of academic stuff that's sort of kicked around our way or been shared with us that we've repackaged and put back on the site. I think, as Sam said, he's just rebalanced the R portfolio, so there'll be a bit of commentary going up on there for anyone that is invested in those or wants to know more about them. But no, otherwise all good.
Yeah. Thank you.
Great. Thanks, Sam. Cheers. See you next week. Bye.
Bye-bye.